Hey everyone, Coach Investor with the big one here, Tesla's earnings report. Now, this is just my personal view. In my opinion, this is one of the weakest Tesla reports we've had in a while. And so it does not surprise me that suddenly the stock is up 1.8% at the time of making this video. Of course, we still have the earnings call. A lot of things can change, especially when the market will open. But previously, we've had better results, better reports, but the stock went down. Suddenly, it's like we're in bizarre world. Anyways, we're gonna have a look at that report. I first want to start off with this. Cybertruck production remains on track for later this year, with first deliveries scheduled for November 30th at Giga, Texas. And then we actually have this on the Cybertruck page on X. Cybertruck delivery event. You can clearly see it's going to be extremely official, pretty cool. And like the kilowatts is saying here, referencing the original 2019 teaser image. Now, before we jump into the report, a quick recap of what analysts are expecting when it comes to sales for fiscal year 24 and 25. Now, for fiscal year 24, they expect sales to reaccelerate. So for this year, it's only up 21.85%. For fiscal year 2024, that should increase to 26.64%. And then fiscal year 2025 to 23.25%. Now, when it comes to EPS, we know margins are getting hit, lower prices, lower demand globally for cars because of high interest rates. So for fiscal year 2024, EPS gets hit by 17.69%. But then fiscal year 2024, reacceleration 37.96%. Then fiscal year 2025, 27.93% growth when it comes to EPS. So currently we are having a number of around 66.4 times for a forward PE. Of course, that might change a bit depending on the stock price when the market opens. So let's jump into the report. Profitability-wise, 7.6% operating margin in Q3, $1.8 billion GAAP operating income, $1.9 billion GAAP net income, and $2.3 non-GAAP net income in that quarter. Cash, plenty of cash for Tesla. So operating cash flow was $3.3 billion, free cash flow $0.8 billion, and then $3 billion increase in their cash and investments quarter over quarter, which reached $26.1 billion. I mean, it's enough for them to invest in whatever they want to do. Some would say share buyback program, stuff like that. With regards to operation, 4 gigawatt hour of energy storage deployed in Q3 and more than doubled AI training compute. Now, you will see here again with regards to solar, what we've been seeing with the likes of SolarEdge and Enphase. The demand is just not there today. So, with regards to the summary here, if you've been following Tesla, if you've been following my weekly summaries, of course, I'll touch on the earnings call in the weekly summary on Saturday. So they say here, our main objectives remained unchanged in Q3, reducing cost per vehicle, free cash flow generation while maximizing delivery volumes and continued investment in AI and other growth projects. Which leads us to the overall numbers. So total automotive revenue only increased 5% year over year. It's down quarter over quarter. And energy generation and storage revenue that increased 40% year over year. Services and other revenue increased 32%. Again, don't sleep on the energy side of the business. I believe gross margins are now over 24% or so, and they're still ramping up. So that's pretty impressive. Total revenue increased 9%. Total gross profit decreased to 22%. And so total GAAP gross margin decreased as well quarter over quarter and year over year. Year over year, we're down 719 basis points. Now, while we see another increase, which, okay, fine, if Tesla needs to invest more right now, makes sense. Operating expenses, that's up 43% year over year. It's also up quarter over quarter. Income from operation is down 52% year over year. And so operating margin 7.6% for this quarter. That's down 964 basis points year over year. I mean, we've seen this coming for a while, but although these are short-term issues, long-term, I still think the company will be fine. But this isn't a great report. There's no other way to put it. This isn't a great report. But let's continue. If you enjoy these type of videos, leave it a thumbs up, subscribe for now. We're on our way to reach 30,000 subscribers, so let's try and reach that before the end of the month. Thank you very much for all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, continuing here, adjusted EBITDA and adjusted EBITDA margin, that is also taking a hit. I mean, logically speaking, just following the trend that we've seen here before. Then, when you look at free cash flow, although it's down quarter over quarter, it's nice to see that it is still closer. Well, the increase or decrease here is not as radical as what we've seen here in Q1, went from $1.42 billion in Q4 to $441 million. But free cash flow, you will see later on the graph, it has never really been that stable. So we're down 74% year over year. But cash equivalents and investments, that's up 24%. So, okay, it makes sense. If they want to invest in the business, I mean, go ahead. Why not? Then, when it comes to the financial summary, so the positive points here, growth in vehicle deliveries, growth in other parts of the business, negatively impacted by reduced average selling price year over year. I mean, we knew that, and negative FX impact of around $400 million. When you look at profitability, of course, the reduced ASP due to pricing and mix, increase in operating expenses driven by Cybertruck, AI, and other R&D projects, cost of production ramp and idle costs related to factory updates, and negative FX impact. On the positive side, growth in vehicle deliveries despite the margin headwind from underutilization from new factories, lower cost per vehicle and IRA credit benefit, gross profit growth in energy generation and storage as well as services and others. By the way, going back to this point right here, underutilization of new factories, now that the upgrades are already behind us, we should see a margin improvement. But I'll have to add another negative point a bit later on. Then growth in regulatory credit sales. Of course, some will say, especially Gordon, will say, oh, you see, Tesla is only doing okay because of regulatory credit sales. Okay, fine. Right now, we're all surprised by the huge increase of that number. But I mean, in the future, I don't think this will become a meaningful part of the business. Now, the numbers here, we've gone over that already. So total production overall is up 18% year over year. Total deliveries is up 27% year over year. Now, if we look here at solar deployed, it's down quarter over quarter. It's down 48% year over year. We've seen this when we talk about Enphase, Solar Edge. The market right now, when it comes to solar, because of the high interest rates, it's not that hot anymore. But on the flip side, storage deployed, that's up 90% year over year and still ramping up. So that's pretty impressive. Then when it comes to vehicle capacity, the only difference here, well, two differences. One, Shanghai is now at over 950,000. I mean, I think they just forgot to update it beforehand because it's been at that number for quite a while. When it comes to Cybertruck, we're now in pilot production and they gave us the capacity here. So over 125,000. Okay, pretty good to hear. Let's wait and see what the actual numbers will be in the coming quarters. Then, the not so great language that they are using here in the report. So when it comes to California, Nevada, and Texas, we are expecting the Model Y production rate in Texas to grow very gradually from its current level as we ramp additional supply chain needs in a cost-efficient manner. Again, very gradual. Shanghai, we do not expect a meaningful increase in weekly production run rate. Berlin, similar to Texas, further production ramp of Model Y will be gradual. In my opinion, Tesla is now finally realizing that, yes, the current macro environment isn't great and it doesn't really matter if you reduce the prices even more and more of your cars. Right now, the sentiment isn't there. And so maybe that's why they're using this language. Again, I could be wrong, but this is just my interpretation of this. Of course, do share yours down in the comments below. Moving on to some positive things, we can see here the cost of goods sold per vehicle continues to go down. So they say here, despite macroeconomic headwinds, our planned factory shutdowns in Q3 and ongoing ramp at new factories, our average vehicle cost was around $37,500, and we continue to work to reduce the cost further. Pretty impressive. As for energy storage business and the services and other, it continues to be pretty positive. Then here the outlook, still pretty much the same for 2023. We expect to remain ahead of the long-term 50% CAGR with around 1.8 million vehicles for the year. I believe they still have to produce or deliver, I should say, 450,000 to reach that number. So I don't think that should be such a big issue, especially not after the Q3 upgrades. I mean, Q4 should be a much better quarter, so reaching that number shouldn't be an issue. Let's wait and see what they will think 2024 will be. As for the rest here, nothing really changes when it comes to the language that's been used. Then with regards to the pictures here, they basically show us the starting price for Model Y. This is inclusive of national and state level subsidies. And again, not everyone will be eligible for these discounts. So in all states, you're now at $36,490. Pretty good deal if you're asking me. Again, only if you include all the subsidies, etc., etc. We then have that amazing picture here that says also deliveries begin in November 2023, which is obviously November 30th, so really at the last day of that month, but that's pretty cool picture here, Tesla Semi and then 3 Cybertrucks on it. Then for the broader picture, when it comes to vehicle deliveries, we're still pretty much on track here. Very good to see. Operating cash flow and free cash flow, I mean, it's a pretty dirty graph, let's call it. So up, down, up, down, up, down. It's a roller coaster of a ride. Net income and adjusted EBITDA, of course, we've peaked back in late 2022. Then we went back down. Margin pressure there. Let's wait and see what happens towards the end of this year, beginning of 2024. And yes, while right now, when it comes to revenue growth year over year, we're still above the S&P 500 and the auto industry. But with regards to operating margin, we're now well under the S&P 500. And we're closing in with the overall auto industry. By the way, with regards to the regulatory credits, the number this quarter is basically doubled that of last quarter, $554 million. And so currently, I mean, since the last time we touched on the stock, not much has been happening here. In my opinion, I don't really see how the stock stays green tomorrow unless something extraordinary gets mentioned into the earnings call. Maybe we might see a retest of the $230 mark here at around the 200-day moving average. Remains to be seen. Of course, I'll cover that in the weekly summary on Saturday. So overall, in my opinion, this was one of Tesla's weakest report in a long, long time. That said, there are still some good spots that we've gone on to. Short-term headwinds should turn into tailwinds somewhere around 2024. I would probably project mid-2024. That's when maybe rates will already get cut. And that should help the auto industry, should help the solar industry as well. Of course, do share your thoughts down in the comments below. What did you think about this quarter? Let me know down there. If you enjoy this type of videos, give it a thumbs up, subscribe if not, and I'll see you all in the next one. Bye-bye.